If you wish you had bought NVIDIA, Palantir, or Seagate Technologies before they went parabolic, you're in the right place. Today, we're going to break down and answer the question, what are growth stocks? And more importantly, how to find them before they explode. By the end of this video, you'll know exactly what growth stocks are, how they should fit into your portfolio, and how you might be able to spot the next potential NVIDIA or Palantir before everybody else is talking about it. And if you stick around to the end, I'm going to share with you a bonus tip on the single biggest mistake beginners make when investing in growth stocks and how you can avoid it. Let's start with the basic question. What are growth stocks? Growth stocks are companies that are expected to grow their revenue, earnings, and market share faster than the average company, faster than their competition. Think tech innovators. It's not hard to picture stocks like Apple, Tesla, NVIDIA, and as I mentioned this year, Palantir and Seagate Technologies that have been huge. They reinvest profits into expansion, research and development, and new markets rather than paying big dividends to investors. The key is you're not buying them for what they are worth today. You're buying them for what they could be worth in the future. Again, forward-looking estimates of what their revenue and growth is going to be. For most beginners, a reasonable starting point might be somewhere between 20 to 40% of your portfolio in growth stocks. Enough to boost your returns, but not so much that a bad quarter or two wrecks your game plan. The rest of your portfolio you can invest into dividend-paying stocks, value stocks, index funds. Those types of things will give you some stability in addition to your growth. The real thing is you got to remember there is no magical answer when it comes to asset allocation. It's up to each individual to determine what is appropriate for their own investment goals and personal risk tolerance and that temperament that we want to develop as a healthy investor and trader. Here's what we look for when hunting for growth stocks. Revenue growth. That's the first thing. 10% or more a year is a good start. Big TAM, total addressable market. Are they solving a massive problem? Are they disrupting an industry? Are they innovating in a way that is a game changer, that has a high demand that's going to satisfy a lot of people's needs? That's important. We're looking for strong margins. Growing companies should have room to reinvest that capital, that growth, those profits into further research and development, new products, infrastructure expansion, so on and so forth. We want to see them reinvesting into the growth of the company. And then innovation, constantly releasing new products, pushing the market state of the art, entering new markets. Those are the things we're looking for. Here's the bonus tip. Watch the company's earnings calls. That's where you can listen in and you'll see if management is confident and if the analysts are raising future estimates. We want to see future guidance, raised guidance projecting strong growth. And that's just the start. Now that you know what growth stocks are and how you could potentially spot them, you need to know how to analyze them so that you don't overpay. Click on the video right here to watch how we break down our exact stock analysis process step by step. We want to make sure we have a good understanding of fundamental analysis so we can help ourselves determine value better. And we also want to have a really good foundation in technical analysis so that we can study the price action of the asset and identify the right time to look to buy those growth stocks. If you found this video helpful, smash the like button, hit the subscribe button, and hit that notification bell so that you don't miss the next video. And let's go find the next Palantir together.